My name's Andrew Stotz, and this is the Valuation Master Class Show. You may notice my camera is a little different. I had a little technical difficulty, and luckily I have a pretty high quality camera here that I'm using, but it's a bit wider, so you can see a little bit of my office and the light. So I'm going to go through today something I've been working on, and that is almost everything I know about discount rates. Now, if I'm not answering a question that you have about discount rates, then something's wrong. So I've missed something. So I think today's session, you're going to get everything that you need to know. Now, as always, if you want this PowerPoint, just send me a message at me@andrewstotz.com, and I'll send you this. And one thing I would say is that discount rates can be very confusing, and they can be overwhelming. And the first thing I want to just express is that that's not uncommon. No matter how much you know, what you find is that there's a lot to be learned in discount rates. Also, you're going to find in one of the questions that I'm answering in here, I'm going to go through a series of questions and try to answer them. But in one of those questions, what you're going to find is that the discount rate concept, and especially the equity risk premium, is just very unclear. In fact, I was recently working on something where I was going to go into a lot more detail on equity risk premium. And by the time I worked on it for a while, I thought, it's not worth it. There's not enough grounded in fact for the equity risk premium to be something that we really, really should do a lot of research on. Nope. And ultimately, I'm a practitioner. All my life, my career has been in finance. So although I teach, all I've been doing is applying these models in my life. So let's get into it. I'm going to open up my PowerPoint here. And the first thing I want to do is say that a discount rate is a judgment tool, right? There's no correct answer. So stop freaking out over it and trying to get a correct answer. You're never going to get a correct answer. Mechanically, it's converting future cash flows into today's value from relative business risk that investors can observe and compare. And that relative business risk is related to the free cash flows of the company. But it cannot protect against surprises, bad assumptions, or unknown events. So these are things that, there's not a lot you can do about those things. Now, from my experience, most valuation mistakes are conceptual, not mathematical. Anybody can do the formulas. It's important to reflect risk in either the cash flows or the discount rate, but not both. And that is a key mistake that people make. And risk can be adjusted for in the DCF model, and uncertainty cannot be predicted or measured. Now, I just want to take a moment and talk briefly about this concept of you either are going to reflect the risk in the cash flow or the discount rate, but not both. We're going to look at this in a little bit, but this is a key thing, and it's an area where a lot of people make mistakes. They are conservative in their cash flow, and then they're conservative in their discount rate. Basically, they're double counting risk. So get your discount rate or put it in your free cash flow. Now, what I tell my analysts, from my research team experiences, I always tell them that get your free cash flow forecast right. That's your foundation. Don't try to make it optimistic. Don't try to make it pessimistic. Try to make it your base case. And that is your starting point. And then once you've got that set, which takes a lot of work, and that's why I say 70% of valuation is forecasting. Once you've got that forecasting done, then you apply your discount rate. And so think of your free cash flow as the base case, not accounting for risk. So for instance, to think of it this way, some people may say, oh, but this company is super risky, so I'm going to reduce the free cash flows from what I think it will be, but reduce it because there's a lot of risk there. No, that's not the right way to do it. The right way to do it is to forecast your base case free cash flows and then be comfortable with that, leave that, and then apply risk through the discount rate. So now let's continue on, and I'm going to go through some more of these. So I've broken this into 4 parts, and I've decided I'm just going to go as long as it takes to go through these 4 parts. So what the discount rate is really doing is part number 1. So first question is, why use CAPM at all if beta works poorly in the real world? It's been a lot of research that shows that beta is not a reliable tool. Now, before we go into that, let's set a definition. Required return is the return an investor needs to justify taking on an investment risk. The required return is like a sexy tool that basically someone says, I require that you have a return above this, or I'm not going into that stock or that investment. So CAPM is a framework. It's not a description of reality. It's just a framework. It's not a rule. It's not a law. It's just a framework. So never put too much trust into CAPM, because all it is trying to frame your thinking. The second thing is it provides a consistent way to translate risk into required return. Yeah, we're looking at risks and we're looking at required return as we go through this. And then finally, beta, which is a component of the capital asset pricing model, is an imperfect input that requires judgment. And later, we're going to look at, what's the best way to calculate beta in the CAPM. But before we do that, I just want to now speak for a moment about this, because once we understand that the capital asset pricing model is just a framework, it does not work consistently. It's a little bit like AI, AI gives a lot of good answers, but then, all of a sudden, boop, it gives something weird, right? Like the other day I put a link of a podcast and I said, this is a podcast episode between this person and that person. Please summarize it. And you know what it did? It gave me a completely different person, a completely different podcast episode that somehow it dreamed up that that's what this was. So, and if I was to be putting my money down, which we have to do in the stock market, on that AI outcome, I would have lost all the money right then. Boom. I would have done really well. AI is great, 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 great. And then it gives you a stupid answer. You put your money down on it, and then you lose your money. And the same thing is the case with CAPM. You basically are going to get silly answers out of CAPM. If you were to take CAPM and come up with your methodology of how you're going to calculate your CAPM and all of that, and the CAPM ultimately is how you're calculating your weighted average cost of capital, usually is what we're talking about. But once you have calculated that required return through your CAPM, basically what's going to happen is that you're going to, if you were to apply that across, let's say 100 companies with that methodology, there's going to be errors in it. It's going to be mistakes, and you're not going to come up with a valuation that you can truly rely on. So with that behind us, let's now go back into the next question, which also remember that CAPM's value comes from consistency, not precision. That is a key thing. Once you understand it's a framework, then you don't try to get precision out of it. Now, how does a discount rate reflect risk, and how does changing it affect valuation? Well, first, let's remember that risk can be estimated and adjusted for in valuation, but uncertainty cannot be reliably measured or modeled. So always think we're looking at risk in valuation. Now, the discount rate prices risk, not uncertainty. And uncertainty means that outcomes that you're not expecting. So higher perceived risks raise the return investors are demanding. That means every time that I use the word, let's say, whenever I do the formula for the discount rate, I always use R. And R, rather than, some people use I, like in textbooks, they have using I for the interest rate. I don't use I use R, because I want it to remind me that I'm looking at the risk. Next, a higher rate reduces present value by compressing all future cash flows. So let's look at the next question, which is, why is DCF valuation so sensitive to small changes in the discount rate? Yeah, this is a big one. So first, discounting compounds over time. So we have to expect that we're going to see impacts over a long period of time. And because of the compounding aspect, those differences can be big. The discount rate affects every future cash flow. It's not like you're applying it only to the recent one. When you make a change in it, you're applying it across all the cash flows. And that's part of what makes it so extreme. And depending on the length of your discrete period, value could be concentrated in terminal value. And finally, small rate changes therefore have large valuation effects. Now, I do want to talk a little bit about this idea of your discrete period and your terminal period. So if we look at this, and by the way, if you have any questions as I go through this, just put your questions in the chat. I haven't seen any questions yet in the chat, so feel free to put them in. It always makes me a little nervous when I haven't seen anything in the chat, because it makes me wonder, oh, I hope I'm transmitting. So if you're hearing me, say hi in the chat. Anyways, let's go back to this idea of the discrete period and the terminal period. In all evaluations that I do and that I use in my business and that I teach in the Valuation Master Class Bootcamp, basically we have a discrete period and a terminal period. Now, we also have a third period that most people don't put in their model, and that is a fade period. So basically what we're saying is that this company's growth or returns could be high for the next 3 years. And then it's going to go to average, but it's not going to go to average in the 4th year. It's going to fade down to the average. And then the average is what we apply to the terminal value. So really it depends on how long your discrete period is. Now, when you're evaluating a company like a startup, there is no cash flow, maybe for 5 years, for 7 years, for 10 years, depending on the startup. So basically what's going to happen is when you have no cash flow or very, very little cash flow in the initial period, in the discrete period, then all of the value in a DCF model is going to be pushed into the terminal period. And that's very different from, take a company like Microsoft as an example, or Google, or Meta, or whatever. All of these companies are hugely profitable. In other words, in fact, you could argue they're never going to be this profitable again in the future. And you could argue that almost all of the profitability and the value is in the discrete period. And what's being pushed out to the terminal period is very little. So this is why I mentioned it depends on the length of your discrete period versus your terminal period. And it also depends on the differences in those. So this is something important to think about. So let's now continue on. We've got a lot of good questions that I'm going to try to address. So the next one is, what matters more for valuation, changes in the discount rate or changes in the growth rate? Well, it depends. It depends on how close the discount rate is to the growth rate. And when that gap is small, valuation becomes extremely sensitive. And internal consistency matters more than ranking the inputs. So what I'm saying in this case is, let's think about this for just a moment. We know that let's just take the most common way or the simplest way of valuing a company, which is the constant growth model. So we use the constant growth model, and the denominator of the constant growth model is R minus G. That's the weighted average cost of capital, or the risk, the discount rate, right? And we can say when R is 10 and G, let's say R is 10 and G is 2, there's a big gap. So making changes in those doesn't have a huge impact. But let's say that R is 3 and the growth rate is 2. Making changes with that small gap can have a huge impact on the value. And from my students' perspective, I've seen them struggle for hours. I've done it myself too, where you could spend hours trying to figure out, why is this so sensitive? So the most important thing you want to think about in relation to the discount is understanding that gap between the risk or the discount rate and the growth rate. And usually it's free cash flow. And so we're saying, what is the weighted average cost of capital minus the growth in the free cash flow? So that gives you some idea on that one. Let's continue. This is fun. Now we got a lot of things we're going to cover. Let's continue on. So that completes part number 1, which is what the discount rate is really doing. Let's now look at part number 2, which is building your discount rate. So when should I use the weighted average cost of capital versus the cost of equity as a discount rate. Pretty simple question. You use the WACC when discounting free cash flows, and you use the cost of equity when discounting cash flows available only to equity holders. And mixing these cash flow definitions and discount rates breaks the whole logic of the valuation. So free cash flow to the firm, WACC. Let's say dividend discount model, or free cash flow to equity, cost of equity. Now, how do I calculate WACC and what are its core components? So WACC combines the cost of equity and the after-tax cost of debt. And each component is weighted by its market value, not book value. And the tax shield that debt provides reduces the effective cost of debt. And WACC represents the required return on the firm's operating assets. So let's look at this in a little bit more detail, because sometimes people can get confused in this area. But if we look at this for just a little bit, when we think about what is the cash flow that flows to the equity providers of a company? Well, generally, it's going to be dividends. Or you could say it comes from net profit. Well, is net profit before or after tax? It's after tax, right? And if it's after tax, then we don't want to put in a before tax debt cost. And that's the reason why we reduce the cost of debt by the tax rate in order to make the cost of equity and the cost of debt comparable in the model. So that's a key part. The second key part here is we use market value, not book value. And so in our model, I look at both market value of debt to equity, and that. So if we look at debt to equity in a typical valuation model or in a typical valuation or analysis of a company, that's generally book value. And then when we do it in the valuation, when we're constructing the weighted average cost of capital, we're going to use the market value. All right, let's get back to the questions. Let's go to the next one. So how do I estimate the risk-free rate, and which maturity or country should I use? So the risk-free rate should be a default free government bond in the same currency as the cash flows. And the maturity should roughly match the duration of the cash flows. Now, this is an interesting one. I had a lot of questions, when I was younger on this, and I resolved a lot of those questions when I was head of research over the years. And that is, every country technically has a risk-free rate, which is their government bond rate. So let's imagine that you live in the US. Your government bond rate is your risk-free rate. But let's imagine that you now are going to invest in, I don't know, let's pick a country, Italy, as an example. And let's say that there's a lot more risk in Italy. If there's a lot more risk in Italy, what can happen? Well, the biggest thing that could happen is that you convert your dollars into euros, right? And what happens is that now you're exposed to the euro, and you use the euro to buy the Italian government bonds. So you've actually made two investments, into the currency and into the government bond. And therefore, it's not risk-free for you as a US investor. Just the way that for a non-US investor, when they invest in the US, the first thing they have to invest in is dollar, and then they buy the underlying asset. So this is an important thing. And every time I do a valuation, the way that I do it is I just do the valuation in local currency. And I say, this is what this company's worth. But if I'm talking to a client that's investing and they're sitting in Boston and they're looking at this valuation, I basically say to them, it's your job to think about what is the currency risk here. If you think the currency risk is neutral and I've got a 20% upside, then you've got a 20% upside. But if I try to bring the currency risk, my assessment of the currency risk, into my valuation, then we're probably double counting it when it actually goes outside. In this case, I'm talking particularly about Thailand. All right, let's continue on. So which equity risk premium should I use, and how is it determined? Well, there is no single correct equity risk premium. Historical estimates reflect long-term experience, but they lag current conditions, so you can't rely on historical estimates. And implied premiums reflect current market prices and expectations, and forecasted so this is the problem with implied premiums, is that you're taking into consider what the market's saying today, right now, and that could distort things. And forecasted premium models are inconclusive. And I want to just mention about this because I was really I was working with one of my students who worked with us also, Christian Schmidt, and I was saying we should really do an equity risk premium section in the Valuation Masterclass bootcamp to break down more information and how do you use this? Because I saw, for instance, the fantastic man, Professor DeMorteran, who produces all these equity risk premiums and equity returns and all that. And I felt I want to do this and make sure that I've got a clear message to my students. But after I worked on it for a while, I threw it away. It's not worth the time. That's my conclusion. In fact, I was looking and I couldn't find it, but there's a book in my bookshelf here that is an academic conference where the best and brightest people got together to talk about the equity risk premium. And when I looked at the final result of that and I read through all the different papers, it was inconclusive. And they said it was inconclusive. So once I really understood that, that really helped me to understand that CAPM is just a framework. If you're looking for answers in the CAPM, you're not going to find it. Now, that's very different than the law of gravity. We can rely completely on the law of gravity, right? That's a very, very clear law, but not the CAPM. All right, let's continue. So the premium must be consistent with the rest of the valuation. That's the main thing. But ultimately, what I teach in my Valuation Masterclass bootcamp is to think of it like a pizza. Basically, there's many ways you can slice a pizza, but what matters is the size of the pizza, not how many slices it's in. And I would argue that the risk-free rate and the cap and the equity risk premium are just slices. Then the beta, just slices. Don't worry about the slices so much. Worry about the cost of equity that you end up with. Now, how do I estimate beta, and should I use raw, adjusted, industry, or regression beta? Well, company regression betas are often noisy and they're unstable. Many companies have a huge amount of volatility. And industry betas provide a cleaner estimate of underlying business risk, but may not truly apply to that company. And adjustments matter less than matching beta to the firm's economics. Now here, I can help you with some of the academic style research that I've done. And there's plenty of good academic research out there. And basically, my research shows that high beta companies revert towards the beta of 1. Let's say the average beta is 1. They revert towards 1, and low beta companies revert towards 1. They don't get to 1, but they get close to 1. And what this tells you is that high beta companies are going to fall. Extremely high beta companies are going to see their betas come down, but they're not going to go to 1. So you could argue that 1 may not even be the best estimate for beta, because you got to remember also, when we're doing beta, we're looking at it on a long-term basis. We're saying we're valuing this company's cash flow to infinity. So when we're estimating a beta to be used in a model, we're estimating a beta that's going to be used across all of time for that company. And that's why what I do in my class, I teach my students to use a beta for a high-risk company that has a high beta. Let's say it has a beta of 2 right now. Use a beta of 1.25. And let's imagine a low-risk company that doesn't move much relative to the market. Let's say the correlate or the beta is, let's say, 0.4. If you got that one, then use 0.75. So therefore, you're going to have 3 potential betas that you can use. 1.25 for high risk, 1 for typical company, and 0.75 for low risk. This is the simplest way to do it that I can come up with that will help us prevent us from making a mistake in our beta. Now, that doesn't mean that you couldn't use a higher or a lower beta. But if you go outside of those parameters, you better be thinking very carefully, and you really want to make sure that you can justify it when you go out and talk about the valuation that you've done. All right, let's continue. How do I estimate the cost of debt when market prices are unavailable? Well, here's 2 ways it might work, and that is estimate a synthetic credit rating using coverage or similar metrics, or add the corresponding default spread to the risk-free rate. But I wouldn't waste time on this. That's a waste of time. And I think one of the things that made me a successful analyst over the years was understanding when to stop wasting time. And what I would do is I would assume that the cost of debt is the book value cost of debt. In other words, let's say a company has 100 million in debt, and they're paying, let's say they're paying 10 million in interest costs on that debt. That's a 10% cost of debt. And if the price of that bond started to collapse, then the cost of debt could be rising in the market. So yeah, if you find a case where a company is in an extreme situation where there's a big divergence between the cost of debt, the book value cost of debt or the effective interest rate on debt, when you see that this company is very different, the bonds are very different trading in the market, then maybe do something. But generally 99, maybe 95% of the time, just use the effective interest rate that you calculate on that, or use the face value of it, unless, again, there's some extreme thing. My point is, don't waste time on things that don't add a lot of value, because the other thing to remember is that what is the core cost of weighted average cost of capital? It's not cost of debt, it's cost of equity. You gotta spend your time there. All right, part number 3. Woo, we just passed the halfway part. So internal consistency and DCF valuation. Should WACC be based on market value weights or book value weights? Well, WACC should be based on market value weights of both debt and equity. Now, I've already explained to you that you really don't need to worry about debt too much. But if you had an extreme situation, that would help. But for equity, you always are going to use market values, and they reflect the return that investors are currently requiring. Book values embed historical financing decisions, and they distort valuations. So always, when we come to this question, always use market value weights. Now, there is an interesting situation with this that I want to explain. Recently, we've been valuing in the Valuation Master Class Bootcamp. In fact, tonight we're going to have a presentation from one of the students on a company, and that company has a very, very low price to book. And that means the market value of the company is much lower than the historical, let's say, book value of the company. And therefore, let's say it's trading on 0.5 times price to book. That means that the equity value in the market is much lower than the book value. Now, that's not normal, right? Most of the time, the value in the market is higher, maybe 1.5, maybe 2.5. And we see that price to book is very high, but here price to book is very low. And in that case, what's happening is that the equity value, since there's only 2 components ultimately of capital, debt and equity, when equity is being pushed down by market value till it becomes less and less and less, then debt becomes higher and higher and higher as a percent of total capital. And then you run the risk of calculating the wrong WACC, and you calculate an overly low, a very small WACC, because maybe 80% of the value is, or 80% of the capital structure is coming from debt because the equity's been devalued so much. And that can be a big mistake. So just wanted to highlight that one. Let's continue. Let's continue. Should I use current capital structure or target capital structure? The answer to this is use the target capital structure, particularly when leverage is expected to change. But, obviously, if it's not expected to change, then you're going to have the same capital structure. But this aligns the discount rate with long-term investor expectations, and the current structure only works when leverage is stable. Internal consistency matters more than precision in weights. Basically, in my models, I do allow for a changing in capital structure. And the reason why I built that into my models a long time ago was because I had some cases of some companies that were in distress. And what happened was basically the value of their debt. Now, previously I talked about the market value of the companies going down and down and down. But in this case, the market value of the debt's going down and down and down. And if that's the case, what you'll see is that the value of the equity in the capital structure will be very high. And so then the weighted average cost of capital will be very high. And we had some cases where we had some companies that were turning around from extreme debt levels to become better. And that meant over the next, let's say, 3 to 5 years, you could argue that, the debt structure is going to be much, much less debt over time. And therefore, the weighted average cost of capital is going to fall as the cost of equity and the total equity becomes less of the financing of that company. And so that's the reason why I allow for changes in the weighted average cost of capital. Let's continue. So, can the capital structure weights in WACC change over time, and should they? Yeah, capital structure weights can change if leverage is expected to change, particularly extreme. And WACC should reflect the financing mix implied by each stage. Now, this doesn't mean that you want to make a really complicated model, but just keep this in mind. And next one, how does leverage in the tax shield affect the discount rate? Well, adding debt increases the financial risk that's being borne by equity holders, and higher risk raises the cost of equity. So you can't just try to issue a lot of debt to lower your weighted average cost of capital, because eventually it will raise your cost of equity. And interest deductibility lowers the after-tax cost of debt. The net effect on WACC depends on the balance of these forces. Here's kind of a rule of thumb that I use, and that rule of thumb basically is that if you think about the amount of debt that you have in a capital structure, think of it this way. The first thing is to think that, imagine that 100% of your capital comes from equity. The next thing you want to do is think, okay, what amount of debt would be reasonable to add to this capital structure? Well, let's think, what would be the extreme highest? How much could we borrow from the banks? Well, the banks never want to give you more equity or more debt than you have in equity in the company. So let's take 40% as the maximum amount of debt in the capital structure. That means 60% is equity. Now, if we take a range between 0 and 40, now we can get into kind of the theoretical cost of calculating the theoretical cost, the value of the firm, by looking at how we're going to reduce the weighted average cost of capital. So if we start adding debt from 0 all the way to 40% of the capital structure being debt, then you would be driving down the weighted average cost of capital. But they'll hit a point where people will be, wait, this is too much debt. And at that point, then the interest rate and the cost of equity will both start to rise, and then your weighted average cost of capital won't get the benefit of the debt. And so that range between 0 and 40 is a good way to think about it. And I like to think for my own business, and as I look at companies that I'm interested in, I'm thinking about between 0 and 20 is safe zone. Once they go to 30% or 40% levels of debt, then that tells me it's danger zone. And that's how I would advise CFOs who are managing the debt levels of their business. Now, should cash flows and discount rates be expressed in nominal or real terms? And how do I ensure consistency? Well, the short answer to this is just to remember every number that we ever hear is generally in nominal terms, except for GDP growth, which is generally announced in real terms. So nominal cash flows require a nominal discount rate. And when you think about it, look at the P&L or the financial statements of a company. Are they in real or nominal rates? They're nominal. They're just the amount. So that's what we use. Mixing real and nominal assumptions invalidates DCF. It doesn't work. How do I avoid double counting risk between cash flow assumptions and the discount rate? Well, ultimately, risk belongs either in cash flows or in the discount rate. Conservative forecasts already embed downside risk in the cash flows, and adding risk premiums on top of these conservative assumptions overstate risk. So let's go back to what I said in the beginning, which is use a base case assumption for your free cash flow estimates and then adjust your risk through your discount rate. All right, final area. I can't believe this has been a pretty long one. I've gone through a lot of things, but how do I estimate a discount rate for private companies or firms without public data? Well, start with comparable public companies and similar businesses. Apply judgment, but not precision. Don't waste your time. In fact, I've seen many people that go to work, for instance, in private, let's say, private equity as an example, and they're looking at companies that aren't listed, and then they spend all this time, and I have students that will come to me and go, how do I calculate the beta for an unlisted company? Well, the answer is you don't. You calculate the discount rate. Forget about the components of beta, risk-free rate, and equity risk premium. Think about it from just what is the cost of equity that I should be discounting here. That's the key. Once you've got that in your mind, then you don't get lost in, I don't have a comparable beta. And if you have a boss or a client that tries to push you in that way, just say, no, it doesn't make sense. And here's why. So is CAPM sufficient for early stage private or very risky companies, and how should it be adjusted? Well, generally, my answer is no. Don't use CAPM. Now, CAPM often understates risks for early stage firms, and adjustments introduce all kinds of judgments rather than certainty. So my advice particularly for starting valuing startups, I say don't use CAPM. It's just a waste of time and energy. You're never going to be able to get something really reliable out of it. All you need to do really is think about the revenue of the business and then think about a revenue multiple. I would say that's the simplest way to focus. And if I owned 5 or 10 companies that were startups, I would be focusing completely on revenue. All right, let's continue. So when and how should size premiums or company-specific risk premiums be added? Size premiums reflect empirical evidence of higher risk required for small firms. So if a company's small and you're comparing it to, let's say, a publicly listed company, then you're going to say, I have to add some premium. That means my discount rate is going to be a bit higher. Company-specific premiums apply only when risks are not captured elsewhere. I would not do any company-specific premiums. And these premiums are easily abused and should be used conservatively. This goes back to my free cash flow thing where I say make sure you got a base case estimate on your free cash flow. Make some adjustments for liquidity or size and to your final cost of equity and weighted average cost of capital, and then you're done. Now, how should country and emerging market risk be incorporated into the discount rate? Well, country risk reflects institutional, political, and economic uncertainty, and sovereign spreads provide a starting point. For instance, what is the yield difference between, let's say, Egypt and the US on a 10-year government bond? What you'll find is that there's a huge gap. Egyptian government bond yields are extremely high because you're exposed to risks related mainly to the currency. So exposure matters more than location for multinational firms. We do try to understand more about that. There's more we can talk about when valuing multinationals, but I'll leave that out for today. But blanket premiums without adjustments often misstate risk. Should I use one discount rate for the entire firm or different discount rates for different business segments? Well, different rates are appropriate when risks differ materially. If the risks are roughly the same, there's no reason to try to apply a different discount rate. And a single rate works only when activities are economically similar. But my guideline on this one is keep it simple. Just use one rate unless there's a screaming requirement for using 2 rates. Otherwise, just use one rate. Now, should the discount rate change over time in multi-stage DCF? Well, risks often decline as firms mature and capital structure expectations can change. So the discount rate should reflect each stage's risk profile. So keep it simple. You can just use an average that could account for those changes in the average. But if you want to make some changes to it, you can. How often should the discount rate be updated when interest rates or market conditions change? Well, discount rates should change only when long-term expectations shift, and frequent updates driven by short-term noise reduce clarity. And I've seen many a time where people get all excited about really low interest rates, and so then they go and make an adjustment, which that brings us to a next question. What risk-free rate should I use when long-term government rates are extremely low? This was a question that I got after the 2008 crisis, when interest rates went down close to zero in the US and they went down even negative in Europe. Now, the risk-free rate should reflect current market pricing. Low rates do not invalidate the DCF logic. Normalizing rates introduces some problems, and any adjustments got to be applied consistently. So let's look at this for just a minute. I'm going to go back to this particular question, and I'm going to explain it in a little bit more detail because I find it's a fascinating one. One of the challenges you face is that, let's imagine that interest rates are really, really low. That means government bond rates are really low. So now you bring down, let's say they're 1%. You're going to bring down your risk-free rate in your CAPM calculation of your discount rate. And what's going to happen is you're going to cause the cost of equity to fall significantly if you don't compensate in some other area. And therefore, when your cost of equity falls, because equity generally is, let's say, roughly 80% of the capital structure for the average company, you are going to bring down the cost of equity dramatically. And when you do that, the discount rate's going to come down and the value that you're forecasting is going to go up. So you need to be very, very careful about very low interest rates causing you to overestimate the upside, and think that this company's worth a lot more than it actually is. Now, the comeback that some people have said to me is they say, well, Andrew, but I can buy a 10-year government bond at 1%. So we should use 1%, right? Well, there's a couple of problems with that. The first problem is, well, we're looking at the cash flows to infinity. So you could counter and say, okay, I'll use a 30 bond rate. And let's say it's 1% for a 30-year bond rate. Okay, now I've got the same timing of the cash flows and I've locked it in. Many people did this during the 2008 crisis and they ended up overvaluing the companies and making that mistake. Here's how I think about it. When you're investing in the stock market, you're investing and you're reevaluating, let's say annually, probably is what most people are doing. In fact, we can see the turnover in the market is very high. For the typical fund management company, they used to just buy 20 stocks and sit on them for 5 years. Now, those 20 stocks could be all out of their portfolio in the next year. So the turnover is high, and that means that money's got to be reinvested. And when that money is reinvested, you can think that it's a little bit like rolling it over for government bonds. And so I would argue that just locking your money in for 30 years in government bonds is not the best way to compare it. You want to think about rolling it over. Anyways, that's a little bit more of a complex topic, but I thought it's definitely one that I think there's some interesting stuff related to that. So there we have it, the 4 parts that we went through on this presentation. I think the last thing I'm going to leave you with is the discipline of discount rates. Precision without consistency is misleading. This isn't about being precise because the CAPM is just a model. It's a framework. And every discount rate embeds assumptions about risk, growth, and financing. And the strongest valuations are internally coherent, not impressive necessarily by the numbers. But judgment does not weaken rigor, it completes it. You've got to apply judgment in the case of this type of valuation. So I'm going to stop sharing my screen right now. Hold on. And I'm going to come back to you and say that is my discussion on everything I know about discount rates. I try to do it by going through common questions that I've been asked. If you have questions that you have about this, feel free to leave them in the comments and I'll add them in. I think this is a fun topic and it's something that I think a lot of people get confused on. So thank you for joining. And if you want to become and you want to build a competitive advantage in company valuation, then join us in the next Valuation Masterclass Bootcamp. And I'll see you there and we'll go through all this stuff over and over.